This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. Before this week, the U.S. housing market was already stuck in a holding pattern. Throughout late 2025, high mortgage rates kept many buyers priced out or unwilling to commit, while homeowners with low-rate mortgages stayed put. That combination reduced both demand and supply, creating a slow, uneven market rather than a sharp downer. Home prices stopped rising rapidly in most areas, but they also didn't fall much. Rent growth cooled from earlier highs, though renters continued to feel pressure from elevated housing costs. The overall picture was a market waiting for change, especially from interest rates. Over the past several months, housing activity gradually slowed. Existing home sales declined, new listings increased only modestly, and construction activity softened as builders responded to affordability constraints. Price growth flattened in many regions, with some local declines, particularly in higher-cost metro areas. At the same time, rental markets showed mixed signals. Some cities saw easing rents as supply improved, while others continued to experience tight conditions. Housing remained one of the biggest contributors to household expenses, even as inflation elsewhere cooled. This week's housing data confirmed that the market remained sluggish. Mortgage rates stayed elevated, keeping monthly payments high and discouraging first-time buyers. Home sales remained soft, and price changes were modest rather than dramatic. Builders reported cautious optimism, but continued restraint. Incentives such as rate buydowns and price adjustments appeared in some markets, signaling that sellers are adapting rather than expecting buyers to return quickly. Recent reports showed slight increases in housing inventory, though supply remains below historical norms. That increase is coming slowly, often from new construction rather than existing homeowners selling. Housing analysts emphasize that affordability, not demand alone, is the main constraint. Until borrowing costs ease or incomes rise faster, activity is likely to remain muted. The real trend in housing right now is stagnation with slow adjustment. Prices are no longer surging, but they're also not collapsing. Transaction volume is low, not because people don't want homes, but because the cost of financing them is too high. This is a mixed signal. It stabilizes home values for current owners, but keeps ownership out of reach for many buyers. This week fits into the broader rate-locked housing environment. High rates freeze movement, reduce turnover, and shift power slowly toward buyers, but only in select markets. The longer this continues, the more pressure builds for either prices or rates to adjust. For households, housing costs remain a major strain. Renters may see slower increases, but relief is uneven. Buyers face high monthly payments even when prices stop rising. Homeowners with low-rate mortgages benefit from stability, but may feel stuck if they want to move. A widely recognized signal many Americans notice is when open houses feel quieter or builders advertise incentives instead of bidding wars, a visible sign that housing demand is cooling without collapsing. Next week, watch mortgage rate movements, housing starts data, and any changes in home inventory. Even small drops in rates can shift buyer interest quickly. Also watch rent data and builder sentiment. They often signal where prices may head next. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.